Alright, let's start by talking about my strategy when I first decided to build this dividend portfolio. I had one clear goal in mind, and that was to invest $1,000 every single month into dividend stocks. So if you do the math, that's $12,000 over 12 months. But I didn't want to just throw my money at any random stocks. I followed a strict game plan to make sure my choices were smart and would set me up for success. First off, I only wanted to invest in companies I actually know and trust. So no random hype stocks or risky moves. I picked businesses that I understand and believe in for the long run. Second, even though this is a dividend portfolio, I didn't just buy stocks randomly. I made sure that each stock was undervalued by at least one valuation method, because I wasn't about to overpay and miss out on potential long-term gains. And of course, dividends were the priority here. I made sure that every stock I picked had a strong track record of paying and growing their dividends over time, and I made sure the yield was at least 1.5%. And that was quite important for me, because for every $100 invested, I wanted at least $1.5 a year in dividend payments. So basically no low-paying dividend stocks in this portfolio. Diversification was another big factor for me. No single stock was allowed to make up more than 15% of my portfolio. And I also wanted to spread my investments across different sectors, so I wasn't just putting all my eggs in one basket. Another thing is I also wanted to make sure I was only investing in companies with at least 10 years of consistent revenue or profit growth. That way, I knew I was putting my money in businesses that had a proven track record. And lastly, I manually reinvested 100% of my dividends, not using the dividend reinvestment plan, but actually picking the best opportunities at the time. So that was the entire game plan. Now let's dive into the companies I actually ended up investing in. So over the last year, I built a portfolio of 19 dividend-paying companies, and you've definitely heard of most of them. These companies all pay dividends, and I picked them based on the rules I was just explaining. So let me run through them quickly so you can get an idea of what I was working with. And I've included the price I paid for each stock, so you can check out today's prices if you're curious. So alphabetically, first is ADP, and the company helps businesses manage payroll, taxes, and HR. Avalon Bay, they build and manage apartment complexes. BP, which is a very popular oil and gas company. Clorox, you know them for bleach, wipes, and disinfectants. Ford, they make cars, trucks, and SUVs, so super reliable. Hershey is the company behind chocolate and candies like Kisses and Reese's. Johnson & Johnson is a big player in pharma and medical devices. Kraft Heinz, think about ketchup, cheese, and frozen meals. Then Coca-Cola is the soda giant. You don't really need an intro here. Next up is Mondelez. They make snacks and sweets including Oreos and Ritz crackers. Then we have 3M Corporation, the company behind Post-it notes, safety gear, and a ton of other stuff. Nike produces sneakers, clothes, and sports gear. PepsiCo, think Pepsi, Doritos, and Lay's. Then we have Pfizer, yep, the pharmaceutical company that everyone knows about from the pandemic. Then we have Stanley Black & Decker, a company behind a lot of different tools and security products. Then we have Tyson Foods, the company behind a lot of chicken, beef, and pork products. You've probably had their products before. Then we have UPS, they're the ones who deliver packages all around the world. Then we have Volkswagen, they make their own cars like the Volkswagen Golf, but they also own Audi and Porsche. And last but definitely not least, we have Verizon, the mobile, internet, and TV services company. And now let's talk about the dividend yields, because hey, that's the whole point of this portfolio, right? And remember that one of my main rules to qualify for my dividend stock portfolio was that every company needed to have a dividend yield of at least 1.5%. This rule made sure that I would be getting some solid returns even if the stock prices didn't skyrocket. So let's start with the big boys here, those companies paying over 6%. Pfizer leads the pack with a 6.5% dividend yield. Ford and Verizon are next, both around 6.3%. Then I've also got 4 stocks paying over 5% each: BP, Kraft Heinz, UPS, and Volkswagen. And while these higher yields are great for building income, remember that higher yields sometimes equals higher risk, especially in volatile markets. So because of that, I didn't want to just go with companies that had the highest dividend yields. I also have some stocks that are paying even less than 2%, including 3M Corporation and ADP at around 1.9% and Nike right at 2%. And even though their yields are lower, they're still solid companies with a lot of potential for long-term growth, and they balance out the high dividend payers. So all in all, my portfolio's average dividend yield comes to 4.24%. That means that for every $100 I have invested, I'm looking at about $4.24 in dividends every year. And since I invested $12,000 in total so far, I'll be earning roughly $508.80 annually from dividends. So not too bad, especially as I'll continue investing more. That's gonna be some nice passive income that I can reinvest each year. Next up, we have diversification by stock. One of the rules I followed was to make sure that no single stock accounted for more than 15% of my total portfolio. This helps me manage risk and ensures that I'm not too exposed to any one company. So let's take a look at how the portfolio breaks down. UPS is my largest position at 12.6%, followed by Stanley Black & Decker at 9.2%, and PepsiCo at 8.6%. Then we've got BP and Verizon at around 8.1% each, and Kraft Heinz at 7.4%. And on the smaller end, companies like Johnson & Johnson and Avalon Bay are less than 2% of my portfolio. These companies increased in value quickly after my original small investment, which is why I couldn't buy more shares of them over time. But overall, this strategy has helped me balance risk and stability. With my money spread across 19 companies without any significant outliers, I'm not overly dependent on any one stock, which helps protect me from big losses. And now, diversification isn't just about different stocks. I also made sure to spread my investments across different industries and sectors. That way, if one sector takes a dive, the others might be doing better. So here's how the sectors look. Food and beverage is the biggest chunk at 33.8%, so think Kraft Heinz, PepsiCo, Mondelez, and Coca-Cola here. Transportation makes up 18.9% with stocks like UPS and Ford. Manufacturing is next at 11.7% with companies like Stanley Black & Decker and 3M Corporation. I've also got exposure to telecommunications, energy, and consumer goods, each making up around 8%. And finally, real estate through Avalon Bay is the smallest at just under 2%. I'm definitely considering adding more to real estate though, since I'm really bullish on the industry long term. But overall, as of now, with this sector spread, I'm creating a well-rounded portfolio that can weather the storm no matter what's going on in the economy. And I realized that I might be overinvested in the food and beverage sector now, but I think that's the most important sector for dividend stocks as the whole, as these companies are likely to stay forever in business because people will always need to eat. Alright, now let's get into the actual performance of each stock. So which companies did the best and which ones didn't do so hot? My biggest winners are 3M Corporation, which is up 68.5%, turning my $187 investment into $315. Avalon Bay is another winner, which is up 32.4%, making me a $57 profit so far. ADP is up 32.1% for a $155 gain. Clorox and Coca-Cola also performed well with 16.9 and 19.5% gains respectively. And now the losers. Ford has been down by negative 10.1%, so I'm down $65 on that one. Next is Kraft Heinz, which is down negative 5.1% or a loss of $50. UPS dropped by negative 7.4%, so I'm down $127 there. And Volkswagen is down negative 8% or a loss of $19. But here's the thing, I'm not sweating the losses. With the mindset of long-term investing, short-term fluctuations are completely normal and they're just part of the game. The most important thing is to stick to the plan and keep building a solid, diversified portfolio that will provide reliable passive income over time. And now let's talk about my overall portfolio's return on investment. After investing $12,000 over the year, my portfolio is now worth $12,384, which means I've seen a 3.2% increase. It's positive, but honestly, I expected a bit more, especially when compared to other strategies. For instance, if I had just parked my $12,000 in cash, I would still have $12,000 today, so my dividend portfolio definitely outperformed it. But if I had thrown that money into the S&P 500, I'd be looking at around $12,948 today, or a 7.9% return. So while I didn't beat the broader market with my dividend portfolio, I'm not overly discouraged. In fact, I was running another experiment for 12 months where I invested $1,000 a month into undervalued stocks, and I'll be sharing that update as my next video. So make sure to stay tuned for that video to see whether or not I was able to outperform the market with that strategy. But bottom line, Dividend stocks can be a bit slower on growth, but they're built for stability and reliable income. You'll not generally see explosive growth, but over time they provide solid returns and passive income. And now let's talk about the most important numbers. How much my portfolio actually paid me in dividends over the last 12 months. My total dividend payment came out to $205.33 in passive income. So that's the money I earned just for holding these stocks without having to sell anything. Some companies contributed more than others, and here are the biggest dividend payers in my portfolio so far. At the top of the list, we have Verizon, which paid me $35.68, followed by UPS at $30.97, Stanley Black & Decker at $23.71, BP at $21.38, and Clorox at $14.64. So these 5 stocks alone made up almost 60% of my total dividends, which just shows how important it is to include solid, high-yielding companies in a dividend-focused portfolio. But if we look at dividends on a monthly basis, things are all over the place. Some months were big and some were barely anything. My highest dividend paying month was December 2024 when I received $68.83, while my lowest month was April 2024, so right at the start of my journey with just $1.70 in dividends. And that's because most companies don't pay dividends every single month. Instead, most companies pay once a quarter, which is why focusing on the month-to-month numbers doesn't really give us the full picture. And that's why it makes way more sense to track dividend income on a quarterly basis. And when we break it down that way, we can actually see some solid growth. So in quarter 2 2024, I received $21.79, and then in the next quarter, that jumped to $57.98. By Q4 2024, my dividend income climbed again to $89.21. And now in Q1 2025, I've already received $36.35, and that's still not counting March. So with all the different dividend payments I'm getting in March, I'm expecting Q1 2025 to be my biggest quarter yet. And this is exactly why dividend investing is so powerful. Even though $205.33 over a year isn't anything crazy, it's still completely passive income. And the best part, as I keep reinvesting my dividends and adding more money into this portfolio, these payouts will only grow over time. And that's the real beauty of dividend investing. It's a slow, steady, and a reliable way to build long-term wealth.